I'm Dave Mecklenburg from Shark Trading. Today we're going to talk about floor trader pivots. This will be kind of a new spin on the momentum strategy. Put out that list every day by email for momentum. And so this is a different way to trade a momentum list. But before we get into it, I want to remind everyone there's a high degree of risk in trading, but trading for more than one day, that you can and will lose money trading. Only trade with money you can afford to lose. I know we got some new people after the festival traders. Just want to let you know, look, I learned to trade the same way as you. About 18 years ago, I was working at a place called Trading Markets, kind of early publisher of books, trading books, and then courses, all that good stuff. There's Street Smarts, written by my old boss, Larry Connors. So look, I read a bunch of books, took a bunch of courses just like you. It was available to me free, but I actually had to do it. Number two, no one's going to have all the right answers. You can't copy someone exactly. We're all going to have different things going in our life or our trading. We're going to make it impossible to replicate someone else's strategy. We have a different level of skill, and I consider getting orders off without slips to be a skill. It requires a lot of repetition, a lot of practice. So different levels of skill, different account sizes, different risk tolerance. I find most people who write trading books, teach courses, have a higher risk tolerance than the average person, willing to lose more on each trade, willing to lose more on a series of trades or a drawdown. So we're going to have to make those adjustments for our own particular situation. And because the available time, I encourage people not to give up their day job while you learn how to trade. You have to get in the reps while you have a job. Once you start trading, better to have other sources of income as you're figuring it out. All right, so I do want to remind everyone before we do a lesson here, either by me or one of my guests, trading's hard. I understand all the marketing out there is basically implying something else, but if you accept the fact that trading is hard, you can do a lot of things differently. You do a better job of protecting your principal, your trading account, before you just jump right in. Corollary to that is no one sells money printing machines. There's nothing you can purchase, no strategy you can purchase or learn that's going to magically spit out $300, $500, $1,000 a day. Doesn't exist. I've got a free strategy for you today. I could charge you for it, but whether it's free or charging, it's not gonna magically make you money. So the only way you're gonna learn this stuff is put in the reps. You're actually gonna have to do some work here, and that's how you know this stuff backwards and forward. Get in the reps. Again, I encourage people not to quit their day job. Hey, when you get home from work every day, flip charts 15 minutes at a time, make it a habit. You know how to trade after a couple months or by the end of the year. All right, so since I don't give away money printing machines because that doesn't exist, at the very least, what I will do for you is I'm going to save you hundreds of hours and hopefully prevent you from blowing out your account. So again, keys to a trading strategy. I do this before we look at a strategy. These are the points I like to think about when I put together a strategy. I like to address them. We don't have to have all 8, but probably 6 or 7 of them will be in a strategy. Control or risk. Think about the downside before you think about the upside. Stop is one way to do it, but there's various other ways of controlling your risk. You got to control our costs. Again, commissions are going to be the obvious one, but I consider wide spreads and slips to be a cost. That's why almost all these strategies I do for you are only involve liquid, high volume S&P 500 stocks, right? So you can get filled. You can get filled without a slip. But again, if you're trading a lot, small edge, and giving up that small edge to slips, obviously you're not going to make any money. Simple is always better than complex. Simple seems to stand the test of time, gets outside the noise. I've seen a lot of things stop working over the past 2 decades, but these simple things just seem to keep working. Obviously, the higher the complexity, the higher the likelihood of errors. Errors can be expensive in trading. Range, volatility, whatever we're trading needs to move each day. So again, penny stocks, they don't move. But again, S&P 500 stocks, hey, they move every day. So whatever we're trading has got to move so that there's a possibility of having, essentially, big winners, or, looking for at least 50-cent moves, if not dollar moves. For the trend is your friend. Well, then we're going to be on the side of overall trend, but not just on the side of trend. We want to be side of momentum, where that trend is speeding up. So you'll notice that most of all my strategies, I'm always going in the direction of the trade. We're never trying to catch a falling knife. We're not putting a limit order and letting the price come to us. Price is already turned around and going in that direction. So price is already going up when we go long. Price is already going down when we go short. So we'll see that element in this strategy as well. It's in everything I do. Again, this is just really a different spin, different way to trade this momentum strategy that we discuss every month. Now, part of the momentum strategy is that I don't use a trend filter. For the trades versus, when we do the breakouts, like either I'm above or below the 50-day moving average. I don't do it with momentum, because momentum is really, that's the point. We're just looking for a follow through from a strong day, the previous day. So again, I address trend, but I don't generally use that in the scan. I'm going to use the same scan we use for momentum, so there is no actual trend filter in it. But like I say, I do think about that stuff. Do I need it? But really the emphasis is on momentum. Then I say, okay, I don't worry about trend. All right, confluence of leading indicators. So again, new traders interested in off-the-shelf indicators, RSI, MACD, stochastics, because again, they think it's a way to print money. We know that's not true, but they just think it's an easy way to find trades. And the problem with those, why they're lagging in my mind, is you don't know the entry price and exit price when you take the trade. So when you're looking at RSI and you're waiting for it to hit 30 so you can enter your long, you're not looking at price. You don't know what the price is. You don't know what the price is going to be when RSI hits 65 when you exit. So that's why it's not a leading indicator to me. So a leading indicator has got to tell you your prices, your entry and exit, before you take the trade. So it's got to be an indicator that prints across the price charts. RSI, MACD, stochastics print under the charts, right? What prints on the price charts be a confluence of leading indicators. So again, Elliott wave, Fibonacci retracements, extensions, trend lines, recent highs and lows, today's high, today's low, yesterday's high, yesterday's low, the swing high, swing low. All those are leading indicators. Another one is floor trader pivots. Again, we know those levels before we take the trade. It's actually an off-the-shelf indicator, and we're going to use floor trader pivots. Right? When I do the momentum strategy, our leading indicator is fib extensions and retracements. For this one, we're going to use floor trader pivots. All right, and then the last, hey, our target's going to be significantly larger than our stops. All right, as an individual trader, you're going to be right about 50% of the time. How do you make money? It's because your winners are bigger than your losers. You got to cut your losers once you're outside of normal volatility, and you got to ride your winners to even bigger wins. Easier said than done. We're wired to the opposite. We're wired to hold on to our losers, because it's not a loser if it comes back to break even. Wired to lock in our wins early for fear of giving it back or that turning into a loser. Just as we're wired to want to be right, we're wired to want to be right 80-90% of the time. It's hard for us to accept that we're only going to be right 50% of the time. We're also wired to make things more complex than they need to be. We have difficulty keeping things simple. All right, so these are all things that require repetition. All right, so this is what I consider good goals for a trading strategy. This is going to disappoint a lot of new traders, people who think they can get rich, in a single year of trading with a tiny account. Not going to happen, but I consider 4 to 6 cents per share per trade to be a good edge if we're day trading stocks. So what does that mean in dollar figures? Well, you got to multiply your share size to get a dollar figure. If you're doing 1,000 shares at 4 to 6 cents per share per trade, that would be $40 to $60 per trade, winners and losers. So if you're right 50% of the time, your average winner is 30 cents, and your average loser is 25 cents, and you took equal number of winners and losers, that would average out to 5 cents. All right, again, multiply your share size to get a dollar figure. We're looking for a small edge. We're just going to exploit it over and over and over and over again. That's real trading. Maybe you end up with 100 to 150 trades per month, and you might pull 4 to 7 points out of the market. Again, multiply your share size to get a dollar figure. 1,000 shares at 4 to 7 points per month would be 4,000 to 7,000 bucks. 2,000 shares, $8,000 to $14,000. So you see, you're going to have to put on some share size eventually to make money doing something like this. Non-monetary things is we got to, whatever the rules are, we got to follow them. Even though this looks like a discretionary trading strategy, it's kind of not. It has definite rules, and you have to follow those rules. So even though we're not automating it, we can't, we're not going to have TradeStation do our entries and exits for us. We're going to trade it like it is. So, and then we're just going to track the results and then track the rules too. If you want to test something out, you can just track the rules each month. You just pick a rule, one thing to track, see if you get better results doing it a little differently. And then the last, hey, money management is always going to be your edge. Again, you'll be right about 50% of the time. So how do you make money? Well, again, your winners are bigger than your losers. How do you make sure your winners are bigger than the losers? You have the right money management. Picking your stops, picking your right break-even stop, picking your right trailing stops. That's how you make money. So here is where I do a graphical representation of kind of how do you make money trading here. So this is just essentially it's a random stock that always appears on my list. It's ExxonMobil. It's a high volume S&P 500 stock that's under 100 bucks. And I could have picked any one of these, but all I want to show you is you see these big bars that seem to happen a lot. They're all over the place. And what that's telling you is big winners happen all the time. If you enter early, if you catch the trend early and ride it to the end of the day, you can have a big winner. All right. If you're wrong, if you pick the wrong side, you get stopped out. If you're right, you ride that winner to an even bigger winner. So these kind of big bars happen all the time. Now, one of the things I mentioned about the momentum strategy is even better. We got these little tiny wicks in the direction of the trade, right? So here, tiny wick in the direction of trade, right here as well. So what that is, hey, market picked the direction early. We would blow it up on, say, a 5-minute chart and went in that direction the whole time, right? Or on a short red one, pick that direction, went in that direction early. So if you guessed right and held it to the close, big winner. So these tiny wicks is when you have a bigger wick, hey, maybe it started selling off and then it went and had a big winner in the other direction. So if you tried to enter early, maybe you got stopped out, right? That's kind of how we look at this momentum. But so here's our little spin for today is, well, what if we wait for the pullback to enter the trade? So what's a way to get at these big bars that do have that kind of big wick where it kind of faked out at first or it pulled back at first, right? We're going to do momentum based on pullbacks and pivots here. All right, so momentum trading. Again, this is the same setup for momentum, the same list that goes out. I'm just showing you a different way you could do it, right? We're looking for a bull bar, a daily bar closes near its high, essentially a trending day where it's going to be followed through the next day. Bear bar, the opposite, closes near its low, right? Tight spread with the first few minutes. That's why I do the S&P 500 stocks. Tight spreads first few minutes, right? Can't have wide spreads, can't have slips in their entries. Can't give away our tiny edge to slips, right? So we're looking for these kind of, again, trending. It's got a big bar. I don't actually care that it's necessarily a big bar. All I care is that it closed near its high, right? Kind of trended. This is blowing it up on 5 minutes. closed near its high. Same here. This one's not as high, but again, close enough. Again, trending near its high. Downside, same thing going on, only opposite, right? Blow it up, just kind of trending to the downside and closed pretty close to its low. Right here's a better example of, I don't really care if it's got to have a big bar. It's okay if it's got a giant wick on the other side, as long as it closes near its low, right? Close near its low. That's what we're looking for. I just call it a bull bar, a bear bar. So instead of doing Fibonacci extensions, retracements as our entry on the momentum, we're going to use floor trader pivots. All right, so I color coded this because that's what it's going to look like on the chart here. Only this black is going to be yellow. I couldn't make this yellow. You wouldn't be able to read it, but essentially central pivot. I'm just going to show you there is actually math in this. You could calculate it yourself, but we don't really care about that. I'm not even going to spend any time on this. If you want to look at this, you can stop the recording, because the whole point of this is a built-in indicator. Just grab an indicator and it'll just pop it on your chart. Okay, central pivot. The pivots actually do go to resistance 1, 2, and 3. Just so we have support 1, 2, and 3. And again, I don't care about the third one, so I don't even have it up there. There's a calculation for the resistance 3 and support 3, but all I care about are these 5 lines. All right. So when we pull it up on a chart, it just automatically draws. This is TradeStation. It's just going to draw it for us, right? There's our central pivot is yellow. Our resistance 1 and support 1, blue, and then our resistance 2 and support 2 are red. That's what it's going to look like. You can set this up however you want. I think this is, I know I have changed the look of this a little bit in TradeStation, but I think these are the default colors, but however you want it. But just so you're aware, right? And I just want to show you, look, I just pulled up, stocks from Tuesday when I did this presentation. Just pulled up the stocks just to show you where, look, again, nothing prints money here. Like, there is no magic indicator here, but do want to show you that, look, you'll somewhat find these things can create support and resistance on these lines, right? It kind of hung around your support 1 and then kind of bounced off the central pivot, right? This one just went straight through, but then it hung around the support 2. So we can use these as support and resistance, right? Here's another stock, Tesla, just kind of bounced off the central pivot straight up to the resistance 1, sat on the pivot again before breaking down. Here's Qualcomm, kind of got this kind of grinding action at the pivot, and then it closed, sat right on the pivot when it closed. Kept bouncing up, bouncing at this overhead resistance, popped down, popped back up. So, we can get these kind of, a support and resistance here. And this is what I'm going to use it for, just as extra support and resistance. I'm going to go pivot to pivot. All right. Again, hanging around, bouncing off stuff. Right. Just did a straight bounce, right? That's Apple. And these are just me pulling random stuff on Tuesday. But that's kind of the point. Again, Amazon bounced off it, kind of grinding around it, bounced around it. And so sometimes you can use this or not, but we're just using it as extra support resistance. All right, so what I'm going to do here is, again, our rules on momentum is the entry is a break at the previous day's high for the long, or a break at the previous day's low for the short. So we're not going to do that. Cross that out. We're going to do a reversal through the central pivot, right? And we're always going in the direction of the trade. So that means if we're going long, it's going to come down, pull back down through the pivot, and then reverse back up through the pivot. And then that's the trade, right? If we're shorting, it's going to go up, pull back up through the pivot, reverse, and go back down through the pivot to trigger a trade. So we're reversing through the central pivot. This will be graphically displayed on another chart. Same things going on with stops that are going to work. Again, and then our target, which we're going to change here, instead of using the fib extensions as our targets, we're going to do the next pivot. So on these trending days, we'll have nice targets here. So look, the R1, resistance 1 pivot for the long is the target, and then the S1, support 1 pivot for the short. All right, again, most trades won't trigger, just like momentum. All right, so again, by the book, momentum, right, we were doing a break of the previous day's high plus a few cents here, right? This actually opened up above our entry, so we had to wait for it to come back down and back through it. So goes through the previous day's high by X cents here. I think I was using 10 cents here, and then went up to our targets, which are fib extensions, right? That's how I teach the momentum, right? So a trending day, and then the next day we break the high. Next day we break the high of the previous day to trigger the trade, right? Instead of doing that, instead of breaking the high, let's say this is the high here, instead of breaking that high and trigger a trade like this, we're going to let it come down through the pivot. Here's our pivot here, our yellow line, and I want to have at least one up bar, right? We're going in the direction of the trade, one up bar. It's got to close before triggering a trade. So we get our at least one up bar, triggers a trade. Again, I want to be on the other side of the pivot. I generally use 6 cents here, gives us a little extra space here. Trigger a trade and then go up to the next pivot. I want to get inside the next pivot. So generally use 3 cents inside that next pivot. All right, going pivot to pivot. We're going to pull back down. Want at least one bar, up bar closing below before triggering, and go pivot to pivot. Inside the pivot to inside the pivot. Very simple, right? Another example, again, instead of breaking the high the previous day, we're going to pull back to the central pivot. Again, we want at least one close, go below, and at least one close below the trigger price, and then ride pivot to pivot, right? Stop would be on the back side of the low, right? Stop would be on the back side of the low. Short, same rules, only opposite, right? So I want at least one down bar to close above our entry. We're going through the pivot, then back down through it, right? Stop on the back side, right? Pivot to pivot, inside the pivot to inside the pivot. Again, pull back through the pivot, want at least one close. I'm in a down bar before triggering a trade. And then again, pivot to pivot, stop would be on the back side of the high of the day there. All right, pretty simple, right? Do a quick examples here of that's like by the book, how you want it to work. Here's how you don't want it to work. But again, so gonna come down to the pivot, want at least one close before triggering, triggers, turns around, breaks the low of the day, knocks you out. All right, stopped out. Let's do that again. We got our one bar that closed, went down through the pivot, closed, got at least one up bar, got at least one up bar before triggering. Great. Triggered us in on the next bar, turned around, knocked us out for a stop. Again, short side, same rules, only opposite. Again, here's actually our trade right here where it triggered. So it's touching the pivot here. It did touch the pivot, so I count that as touch the pivot, and then it closed before an entry. So this is just kind of bad luck here, but it gives you a pretty tight stop, only 11 cents of risk here. Touched it on the next bar and then turned around and stopped you out. And then, hey, you know, you want to use some trailing stops here. So we tried to go pivot to pivot, didn't quite make it, right? So it came down. Here we get our close. We got a up bar that closed below the entry here, triggers us in. Didn't quite make it to the next pivot, but certainly if we're trailing here, this is already kind of almost $1 in your favor at this point. So, you know, if you're trailing, maybe in this case, I used this last down bar as the trail. Backside of that, still would have picked up over 60 cents on that. So that's still a good trade. Didn't quite make it to the pivot. Downside, same rules. Didn't quite, just missed making the pivot here. But, you know, trailed on the backside of this move here. Actually missed it twice. And again, got at least a 1 bar close. Down bar that closed before triggering, at least one. Triggers your trade, and then we get knocked out at the trail here. All right, so anyways, it tracks something like this. I've been tracking this strategy for a long time, but 2019 here, this is all 2019, just so you can see my figures here. So for a full year, so you're looking at about, what is this? About 120, about 130 trades a month on something like this, I guess. Do I have that right? Yeah, about 130 trades a month, pulling just over 5 cents per trade as your edge. That's per share. So again, multiply your share size. That was how many points you pulled out of the market, 82 points for the year. Again, multiply your share size to get a dollar figure. So again, just looking for small edge, exploit it over and over and over again. So just remember, we're looking for about 4 to 6 cents per share. I consider to be a good strategy. If we're talking about stocks here, multiply share size, get a dollar figure. Probably looking at about 100, 150 trades per month. And hey, if you can pull 4 to 7 points out of the market, you're doing pretty good. Whatever your rules are, follow your rules. You can test different rules during the month. If you find something better, then that's the new rule. So you trade it like you're a computer. And just remember that the rules you're probably going to play with here are really in your money management rules, not necessarily your setup rules. All right. So pretty quick to the point here, did it in 30 minutes. Again, I'm going to stick around, answer any of your questions on this strategy or any other strategy or anything else to do with trading. But I'm going to stop the recording now.